Before we begin this podcast, we'd like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth's financial products. For NetWealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the podcast guest. More information about the fees NetWealth receives is provided in our financial services guide, which is available on our website or by contacting us.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the NetWealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm Head of Investment Management and Research for NetWealth Investments. In my role at NetWealth, I manage and oversee the governance of the investments that we make available to you through the NetWealth investment platforms. Today we have John Owen, Portfolio Specialist at NAB Asset Management, joining us. Welcome, John.
Paul, nice to be here.
NAB Asset Management have a number of managed funds available on the investment menus across most asset classes that are managed by a number of external best-of-breed fund managers such as Fairview, MLC and Antares. I thought we would discuss with John his views on the challenges facing investors and the lessons that you've learnt over a long career. So starting with the first question, can you share a little bit about yourself, your role, and what really fascinates you about markets and the area you work in?
Well, I started, I'm showing my age here, but I started in the industry in 1979 and I sort of fell into the industry. I got a job at the Sydney Stock Exchange, as it was known in those days, doing company research, and that's really sort of where it started. And I guess my big break was in 1985 when I joined Westpac Investment Management as one of their share market analysts. And I did a lot of research of companies, and I think I earned my stripes by trying to work out what Robert Holmes à Court was going to do with BHP in those days, and we luckily got it right. And then I joined MLC Investment Management, as it was known then, in 1994, and have had various roles within the investment management team. What I like about investments is, well, firstly, it's very important fundamentally to all Australians to provide for their retirement and make the right investment decisions along the way. And I'm in the heart of that decision process at the moment because having turned 63, probably my career is coming to an end and I've got to think about, do I have enough money to retire on and how am I going to invest it through retirement? So those sorts of questions that probably a lot of other people that are listening to this are facing are part of my world at the moment as well. But what I also enjoy about investments is that there are so many things changing all the time and markets change. So it's a very dynamic sector to work in, and just when you thought you'd seen everything, something else comes along.
Yeah, I guess I can appreciate your comments there that for mine, investing is a combination of art and science.
Yes,
and the older
exactly
you
right.
get, I think the more you realise you don't know. And that it's not an art that you can ever master and move on. So I can certainly appreciate your comments there, and sort of interesting that you started in the stock exchange
Yes.
back in 1979. That would have been a different world and a different era of investment management, certainly pro-computer trading and the automation of the stock exchanges. And it would have been a very exciting time to see it actually physically, securities get priced and change hands on a stock market. So it's certainly a different insight and an understanding and appreciation of markets you would have gathered as a result of that there, John. What are the worst investment cycles that you've experienced in your career and why?
Well, there are three that certainly I remember very well. the first was obviously the 1987 crash, where it all happened in the blink of an eye, and markets were down 30 or 40%. And I remember I was having breakfast in my kitchen in those days, and I heard the news that the share market had fallen something like 30 or 40% overnight. And I thought, well, I won't have that second piece of toast. I think I better get to work. And as we were sitting in our investment meeting that morning, we got news that the New Zealand share market had opened down around about 40%. So it was like a tidal wave that was going to come across the Tasman Sea and hit us at 10 o'clock when markets opened. So that was, I guess, a bit of a baptism of fire, because being head of I was head of share market research at that time, and we had to decide very quickly what we were going to do that day. And so I'll always remember that.
Was there anything you could do that day other than to capitulate and join the sellers?
Yeah, interestingly, there was. And it was a bit of a lesson learned that we decided, because the world looked very unfamiliar, very uncertain, that we would try to get our clients' portfolios to a position of around about 20% cash by the end of the day. Now, that obviously necessitated selling securities on that terrible day. Whether that was the right thing to do or not is debatable, but we just thought it was prudent and appropriate to put a bit of protection into clients' portfolios because the outlook was so terribly uncertain. And that was the lesson for me, that on that day, the market changed. On that day, that horrible day, you were able to sell BHP, you were able to sell Brambles, you were able to sell those good quality, I guess, blue chip stocks, even on that horrible day. Whereas there are other parts of the market, the lower quality stocks that were very popular in the year or a couple of years before because the speculators were speculating too much, and the liquidity for those stocks just dried up overnight. And there were stocks that never traded again. So that was a bit of a
buyer at all.
No buyer.
Many sellers and no one willing
Plenty
to
of
step
buyers
up
at
and buy.
BHP, plenty of buyers at Brambles and those sorts of stocks, but the liquidity dried up for those parts of the market. So that was a lesson learned. The other two cycles, I vividly remember the tech boom and the tech wreck. Great reminder that investors sometimes can do really, really stupid things. And during the tech boom, there were companies that had no earnings, they had no sales revenue, they didn't have very good management, and they'd never paid a dividend. But those stocks were valued more than some of the traditional blue chips, or what they used to call the old economy stocks. And then, sure enough, again, just like the October 87 crash, the market changed and the liquidity for those stocks dried up, and the really good stocks started to perform again as well. And the third one that I think was the scariest was obviously 2008, the global financial crisis, that you weren't just talking about people or companies that were getting into financial difficulty. You were actually talking about countries, whole countries, getting into financial difficulties.
And banking systems coming under pressure.
Absolutely. Doubts about the stability of the financial system. And in the space of a year, seeing property prices in places like Ireland fall 50%, or the banking system failing in countries like Iceland. So that was also, I think, probably the scariest for me anyway.
Yeah, I think I would agree with you there that the financial crisis was has left such an indelible mark on investment professionals that it wasn't just one sector like the technology sector in 2000, or even the crash in 1987. There was a lot of returns made in the lead up to the crash, and then it quickly recovered. But 2008 arguably has still left an indelible scar in the banking system and central bankers and the monetary policy and the interest rates that we still live under today. So I can appreciate that, but it certainly brings back to mind also the importance of valuation, not getting carried away with the market when everyone else is buying an asset that looks extremely expensive. But it takes a lot of courage to implement that.
Well, you talk about courage. I remember in the tech boom that I was doing research of Australian share managers for our portfolios, and we had to do a reasonable amount of holding hands in that period of time. That some of our managers, in fact most of our managers, were not investing in those tech stocks that had no earnings and very little substance, whereas the rest of the market was, falling in love with them. And having to reassure managers to don't capitulate. We're not going to fire you because you've underperformed the index. We understand why you're underperforming, and that's because your investment style that you're applying in a very disciplined fashion is naturally not going to lead you to own those sorts of stocks. And those managers who underperformed in the tech boom subsequently outperformed in the tech wreck.
What are the common mistakes that you see people making with regards to superannuation and their savings for retirement strategies?
Well, part of my job takes me to talk to corporate super plans, and quite often I see or I hear through the discussion the profile of the membership of some of these corporate super plans, and I think it's fairly instructive as to maybe Australians in general. So what I see is neglect and apathy sometimes towards superannuation. So the mistakes that people make appear to be they leave saving for a retirement too late. And there are probably very good reasons why some people are forced to defer saving for a retirement, because they've got kids, they want to send them to a good school. If they live in Sydney or Melbourne or Brisbane, they've probably got a fairly substantial mortgage. So superannuation and saving for retirement is not a priority, and is probably so far away that they think they don't need to think about it. But my advice, for what it's worth to anybody who's starting out, is to start early. Don't leave it too late. Even $50 or $100 a month over a 30 or 40 year period can, with the power of compounding and disciplined investing, make a big difference. And I see people do careless things as well. A lot of people, they don't nominate a beneficiary for their superannuation. So if they die suddenly, their dependents are probably left in a fairly difficult financial position because they haven't made a nomination. So it may take years for their superannuation, their superannuation investments to be passed on to their dependents. Whereas if they'd nominated a beneficiary, it can happen very fast. A lot of people don't have a will. A lot of people don't think about enduring power of attorney. If they're in a coma, who's going to make decisions on their behalf affecting their investments or even their health? So I do see a lot of carelessness, if you like, in the average Australian and their approach to superannuation and investing.
It does surprise me, I guess, John, and I agree. I've found there is a lot of apathy towards superannuation, and yet really I think on average it's the second largest investment of any Australian.
Yeah.
And if you think about how much focus and effort we make on our largest investment, being our house and property, it is surprising. But I guess superannuation, again, is quite intangible compared to land and a house that you can see and what have you. But I think some very poignant comments around nominating a beneficiary, thinking about wills, thinking about powers of attorney. It's very simple for a lawyer to assist and not expensive in that area. So, no wise words there, John.
Well, I was just going to add, when I started in the industry back in 1979, the companies I worked for, superannuation wasn't compulsory until the late 80s. And I guess that's where a lot of Australians might be able to get away with it. They may be apathetic towards investing in superannuation, but it is now compulsory. So they can't make a choice. So I guess you could say they can't stuff it up as much as if they had a choice to have superannuation or not, like it was up until the 1980s. And I guess also a lot of Australians are investing their super in what's called a default corporate superannuation fund. And generally speaking, those funds are very well managed, and they've got compulsory SGC contributions going in every month or every quarter. So they may be apathetic and they may leave things too late, but at least they've got the superannuation sector on their side, and they're being forced to do things that if they had a choice they may not choose to do.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
What are the biggest risks that you see that are facing pre-retirees? So those just coming into retirement, potentially like yourself, and retirees. And what type of strategies should they be thinking about that could potentially help manage those risks?
Well, yes, that's very much alive and well in my circumstances at the moment. There are probably two or three major risks, and certainly that I think about as well for my own circumstances. The first is something that sounds a bit technical, but it's usually called sequencing risk. And that's the risk of you're 1 or 2 years out from retirement, you've saved your nest egg over a 40-year period, and whammo, you get a GFC, and you wake up a year later and you find it's worth 30 or 40% less than what it was the previous year, and you're just about to start retiring.
So it's really about the point in time when you've got your largest amount of savings and getting a significant drawdown.
Getting a significant market correction, that's exactly right. So that's a nasty one. And, you know, it's just like somebody retiring in 1987, in 2007, and then a year later, after the GFC, you know, their financial arrangements could have been decimated. The other risk is, I guess, longevity risk. So Australians are lucky. They live in a country where life expectancy is going up, not going down. So people are living longer, and they're also leading not only longer lives but healthier lives as well, due to, you know, better healthcare, and we're eating better than we're exercising more, so we're living longer and they're healthier lives. So there's a very good chance that people still want to travel overseas business class when they're 88, rather than just sort of staying at home. So the money's got to last a long time, and maybe a lot longer than people thought, which again is why people should start saving sooner rather than later. And I guess the other risk is the cost of living risk, is the inflation risk. And it always, maybe I shouldn't say it, but I will, it always amuses me when I see the inflation number coming out and at, 2.5%. Well, I wish my electricity bill had gone up only 2.5% in the last couple of years. Or the cost of private health insurance, or council rates, or the cost of insurance. The cost of living in those sorts of areas just keeps going up. Sure, flat screen TVs are much cheaper than what they were 10 years ago, but how often do you buy a flat screen TV? So it's inflation risk that's always the big one as well.
It always sort of bemuses me or confuses me how the Australian Bureau of Statistics even come up with, I think, there are 22 different measures of
basket
inflation
of goods
or
and
CPI.
services.
Correct.
That's
correct.
right.
There. But it's an interesting issue, those risks there, where a retiree does face sequencing risk and, again, the risk of a large drawdown when you have the largest sum of capital, but balancing that with the longevity issue of the need to have growth assets in a portfolio.
Absolutely.
I think really brings home for my mind that, investing's a difficult game and you do need to work with professional managers as well on that front.
I couldn't agree more. And also, including in that professional manager space, people really should get access to good advice. And the majority of Australians don't have a financial advisor. And superannuation is complicated, tax is complicated, and all those little things like having a will or making an enduring power of attorney, they're all such simple things to do. And that's sometimes where, a financial advisor can make life very, very simple and very easy if people are prepared to pay for that service. You raised an interesting point that one of the mistakes that I think a lot of people make when they hit retirement is they think that they've got to go to what might be an overly conservative or defensive portfolio stance.
To protect
the capital that they've got. And I can understand the psychology of thinking that way, but there's been a lot of interesting, good research that shows that an investor perhaps should have more in riskier assets like shares than perhaps they think they should have. So you need to replenish, once you're in drawdown phase, you need to have some growth assets in the portfolio to replenish what you're taking out every month or every quarter or every year. And probably the best way to do that is to have some exposure to growth assets in the portfolio rather than immediately going to cash or term deposits. And 6-7 years ago, you probably could have had a really good standard of living by investing just in term deposits when the interest rates were 6, 7 or 8%. But at 1% interest rate, that's not a sensible strategy.
Yeah, well, I think we're touching on the next question that I was going to ask about any general guidelines to help different age groups determine the investment strategy that's appropriate.
Yeah.
And I think you've already started to touch on it, that balance, and I sort of raised the issue of the balance between protection and ensuring you have some growth assets. But are there any other general guidelines that you'd comment on for different age groups when investing?
Well, certainly with the benefit of hindsight, I often look back and think, what would I have done differently? And I probably would have or should have been more aggressive in my portfolio strategy when I was younger. If you're in your 20s and 30s, you can't access your superannuation for maybe 20, 25, 30 years. So market risk isn't really relevant. If anything, you should be engaging with that market risk in a sensible way to generate higher returns. Time is on your side. If you get a market correction of 20%, you're in a much stronger position to be able to do a couple of things. You can exploit that market correction by buying more or increasing your superannuation contributions to exploit the market correction. And you've also got time on your side because you're not going to need that super for 30 years. So you can ride those market waves much easier. And you could say the same for someone in their 40s and maybe early 50s, that retirement might still be 15 years away. But it's for the pre-retirees and the retirees where those sorts of issues certainly become more relevant. And maybe downside protection, if possible, is probably more uppermost in their minds.
So I'm guessing I may know the answer here, but to your view. But do you think investors should attempt to build their own investment portfolio?
Ooh, they could. Whether they should is another thing. I mean, my investment colleagues, most of us, maybe because we're brainwashed, but we've got most of our individual pots of superannuation in a managed portfolio. And that might be an MLC portfolio. It could be Australian Super. It could be, Colonial First State. So if you're saying investment professionals who do investments as a profession are investing their own money in a diversified managed portfolio, what hope has the individual investor got? But having said that, people could build their own well-diversified, well-structured portfolio if they've got good advice sitting behind them. And
access to research.
Yeah. And the experience of a financial advice firm who have also probably been in the investment game a long time and understand some of the pitfalls and some of the dangers of investing. So I would never recommend anybody, irrespective of their experience or what they think their experience is, build their own portfolio. And again, maybe I'm brainwashed, but if you're an investor in a large diversified pool of money, and some of the, we manage 80 to 100 billion. Australian Super is now up to something like 120 billion. There's big corporate superannuation plans that have got similar amounts of money. Being an investor in a pool that size gives that investor access to managers around the world and asset classes and strategies that even someone with $100 million can't access them on their own. So that's what worries me sometimes, that I think a lot of people think, I've got to build my own portfolio, whereas a large, well-managed, diversified fund can actually gain access to a lot of those strategies that individual investors can't get access to, even if they think they do have a lot of money.
And finally, is there a golden investment rule that you apply to all your investment decisions, or a few rules that you've accumulated over life?
Yeah, there's a few. The more you fiddle, the greater the chance you're going to stuff it up.
Stick to a long-term strategy.
Stick to a long-term strategy.
Avoid the latest and greatest.
Absolutely. Be sceptical. If it doesn't feel right, it probably isn't. I think as adults, we've all got a pretty good antenna to tell you that something doesn't feel right. I love the Warren Buffett. No interview is complete without reference to Warren Buffett. But my favourite is he likes to be greedy when people are nervous, and he's cautious when people are greedy, and I think that maybe comes down to being sceptical and
easier said than done.
I know.
Said than done.
I know it.
I do.
You haven't asked me what mistakes I've made over the years, and I think we've all made those mistakes. But as long as you learn from them,
correct,
and try and avoid the noise. There is so much
in
noise
this day and age of social media.
That's right. It's social media. It's the media. It's newspapers. It's what's on the TV.
It's not only the cab driver now, but it's everywhere.
Well, it's even including the cab driver. That's right. And the good thing is people have access to more information than perhaps they ever did. That can be a good thing, but it can also be a dangerous thing as well. So,
that brings us to an end of the Portfolio Construction podcast. Thank you very much, John, for attending and for the insights you've provided. Certainly enjoyable, and certainly some very sound advice or general advice that you have provided to myself and the listeners there. So thank you very much there, John. Have a great afternoon.
Thank you, Paul. You're very kind, and nice to be with all of you.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.